Good morning, traders and investors. Are you guys ready for another pre-market prep? Of course, where we get you ready for everything you need to know for the trading markets. Let's take a look. Today, we'll take a look at WTI. We'll see what's going on in oil. Apple taking a hit from China. We'll get into that. We got some earnings reports to run through. Dave and Buster's, ChargePoint, C3AI, American Eagle, GameStop. We'll talk a little bit about that. And do you guys know about the movie called Dumb Money? Tell me about that in the chat if you guys already know about it. Unipath on the earnings. We'll take a look at potential Westrock combination with an interesting company. We'll talk all about that. We'll take a look at some ratings out there. We got Dell, Roku, also got Crocs in those ratings. Don't miss it. And did you guys get your Dutch Bros? I know there's somebody's out there looking at that offering. Let's take a look what's going on underneath the hood. It's pre-market prep. It's time to rise and shine, team. Coming to you live from downtown Detroit, this is Benzinga's pre-market prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day. Good morning, traders. Let's get into it. Let's take a look at the market. The SPY is coming down here. We lost a little bit of altitude yesterday. Definitely lost some altitude. We'll talk a little bit about that. And this looks like a little bit of a head and shoulders just on the hourly. But hey, maybe that should have been something we were looking at. We'll talk about it with Dennis. Let's take a look at the Qs. Qs kind of similar action. Of course, yesterday, tech taking the major pullback. But it wasn't just tech. Looked like it was ugly breath all around. Take a look at the TLT, and you guys can see that now down to 93.86. Will we make our way back down towards the lows? That's the concern in the markets right now. You take a look at USO, oil continuing higher. Look at this daily trend. It's been a nice little push there in oil. We'll see if that can continue. Gold still on the pullback. Silver not doing much, just pulling back and pretty fast there. So I'd leave silver alone there. We'll see what happens on that trade. But let's get into all the tech talk. What happened yesterday? Wicked rotation. We're going to bring on Dennis Dick in just a second. He's getting ready, team. He's there. The one, the only. What's up, Triple D?
Not too much. Just looking at the same story as pretty much yesterday. Tech wreck. So, wow. I mean, Apple is the talk. Down another $5 here. So it goes from bliss, right when Kramer tweets right at the top that you're never going to get a dip in Apple again. Well, it just fell 12 straight dollars. So again, listen to pre-market prep will help you. Don't chase. You don't need to chase in this environment. We started this week's show with that not chasing attitude. Said it again yesterday. What happens? The rug pull. Boom, boom. And Apple's down $12 just like that. This environment is not the same as what we were in when we started the year. When we started the year, all the tech was massively oversold. It needed a relief pop, and that's what we got. We had a huge, and then it obviously continued, and then, and obviously, we had the AI, boom and everything, and was a really good first half. It's just not going to be that easy sledding. You just don't get 28% gains in the Qs and then tack on another 28% in the back half. It typically does not happen. That's why I'm still sitting cautious. Cautious is winning right now. Cautious continues to pay the bills.
All right. We got someone joining in from Croatia. That's what it's all about. Like, I mean, hey, man, we're all over the world pre-market prep. That's for sure.
We had a couple of traders at Bright Trading back in the day from Croatia. Nice country. I've
definitely
never been there,
good people. Definitely seen the Qs pull back yesterday. Definitely put some worry, but it wasn't just the Qs, right? And I could see it all around. It was just seemed to be weakness. And even that call on oil that you were looking at, Dennis, maybe oil starts to pull back a little bit. Yesterday, we did start to get a little bit of a pullback. But if we look at WTI, of course, it was ranging. It had gotten all the way up to 88 0.8 on WTI, which is the highest price since November 15, 2022. So we're coming back to those high prices when we had high inflation. And now we're starting to tick down. We're back towards 87. I see a range of 87.74 and 86.78 on the day. I've been talking about that. If that comes back down below 85, that's when really you'll start to see these kind of oil stocks, I think, start pulling back. Now, of course, we're also looking to see if it goes into the 90 area, because that could continue the oil trade here. What do you think about the oil trade overall, Dennis?
I don't care about the oil trade, really. It's all about tech here. So let's bring it back to tech and talk Apple for a few minutes here, because this is the driver. This is the whole reason the market is down here today. It is 7.5% of the S&P. And when Apple starts to go down, the market follows suit. What is the news, Money Mitch? We know we had some iPhones concerns from China yesterday. It looks like there's more concerns here again today. Do you have the headline?
Yeah, let's talk about it. Apple took a hit. China's decision to ban iPhone from government offices, as Bloomberg reported that on Thursday, said that China's plan to expand a ban on the use of iPhones in sensitive departments to government-backed agencies and state companies. Oppenheimer analyst stated that Apple could lose 10 million iPhone in 2024 due to the new Huawei phone. And so you guys are seeing it, a quick little turnaround here when everyone was kind of looking to see if Apple would get an iPhone jump into, of course, their release next week.
What happened here and what continues to happen is what we've been saying is Apple is priced for perfection. The rant I had yesterday, 30 times earnings. It has no business being at 30 times earnings. I know they say, oh, well, it's a consumer staple, so you got to price the consumer staples. Well, the consumer staples are coming in because rates are higher. They used to trade 26, 27 times earnings. They're not trading up there anymore because rates have come down. So now you start thinking about 22, 23. So if they price like a consumer staple, which maybe it should be priced, it should be 23 times earnings, 24 times earnings. It has no reason other than the ETF effects that are driving this up to make it 30 times earnings. So obviously, it's a huge portion, the biggest portion of the S&P. But I just keep thinking, like, you're investing in Apple at this point in time. I think you're doing it backwards. I had Apple in my long-term portfolio for the better part of a decade, bought it when it was 12 times earnings because everybody says it should be valued as a consumer staple. That was Kramer's argument. It was correct. It was absolutely correct. It should, because everybody was buying iPhones. They weren't going away. And obviously that's their main product with 51% of their revenue. So that multiple expanded. It continued to expand over the course of 2013, 2014, 2015. But revenues were growing. So the multiple was expanding very slowly. But what's happened now is revenues have stopped growing. We're not growing nearly at the rate that we were growing at before. So it's a cash cow now. You think of your BCG matrix back to university, where you got your stars and your cash cows and your dogs. It's moved from a star to a cash cow. I think the valuation at 30 times is insane. I think it's crazy to own Apple at 30 times earnings. So yesterday it was 188. It's 178. I've been wrong. I sold my Apple right around this price, around $180. It was over a year ago. So I actually, I picked up 6% on it because of cash portion. So I've been picking up 4 or 5%. So it's been the right play overall, even if it's the same spot. But because Apple's gone nowhere basically in the last year, if you look at where it is now. But I think Apple, fair value, is 23 to 24 times earnings. So until they can show me a new product, let's bring it right to this. And this is going to be an Apple show here today. Bring it to this, Mitch. What have they come up with? What is their new products in the last decade?
You're right.
iPad. What the hell else have they come up with? They keep making the camera.
Apple TV, maybe?
Apple TV is junk. That's been.
I don't know. I don't think it's junk, to tell you the truth. I really got to say, I don't think that one's junk, Dennis. But it hasn't brought them revenue.
In the chat?
Let's find out. That's an easy way.
I had one. I'll tell you something. I had an Apple TV 10 years ago. I don't have it anymore. You Roku, you got everything else displaced it. I don't think I need it. So AirPods, I like it. They cut the cord, so they're cordless. There hasn't been a hell of a lot of innovation since Steve Jobs left. Let's be honest here. There hasn't been a lot of innovation in Apple since Steve Jobs left. The whole move is multiple expansion. At a certain point in time, you got to show me a new product. You got to show me what you've been cooking with all this R&D. Show me something cool. We've talked about an Apple car for the better part of 7 years on this show. A car is coming. Gene Munster's, it's never come. So I just think we got to look at what we're paying. If you're showing me a company that's growing revenue at an exponential rate, I don't mind paying 30 or even 40, or in the case of NVIDIA, 47 times earnings. But I'm not paying 30 times earnings for a company that is not growing. At a certain point in time, I think that multiple contracts. At a certain point in time, I think it could be 23, 24 times. And that would bring the stock price back to about 140, which is where I feel it should be.
There's a lot of things that, of course, they're dipping their toes in, but that's what I think a lot of people are just kind of praying for, right? It's the Apple Car. Well, the goggles, right? I mean, is that going to be a growth driver, Dennis?
And obviously Meta's
The
got their
Vision Pro?
goggles. All of this stuff. I mean, Apple Watch. I've got an Apple Watch, but this is not reinventing the wheel. They took their iPhone and they put it on a watch. Show me something cool and new. The iPhone was incredible when it came out in 2008, I believe it was. It was first the iPods. There was iPod, it was called, that they had the
Yeah.
one, and then
Yeah,
then they obviously made it in the phone. I'm like, that was groundbreaking innovation. It took BlackBerry out. Actually, it's BlackBerry that probably came up with that, really, when we think about it. And then Apple came and just made it awesome. So I just don't think they've had a hell of a lot of innovation since Steve Jobs gone. Now, does that mean that Apple's going to crash and burn? No, because here's the other, and you were making a good point on this on the pre-market show, Mitch, when we were just talking about what we're going to talk about, is the ETF effects. This is a huge portion of the S&P. It's a huge reason why, the Qs, it's just enormous. It's a huge reason why it gets held up, because the ETF players will buy the stock when it dips for the simple reason of the arbitrage effects. So that helps to hold the stock up. But overall, in the long run, I still believe fundamentals drive price. I don't want to pay 30 times earnings. Come back down to 20 times earnings? Yeah, I'm in. So you drop by a third, 180 down to 120-ish, I'm in. But at 180, and now obviously it came down to 130. Maybe obviously I should have rebought the end of November and got down to 124. But maybe that's where it's a reasonable valuation. At 30 times, it's just not a reasonable valuation, not for a company that's growing as slowly as Apple.
Of course, that's the question. I think everyone kind of knows it. It's probably the most held stock in the stock market, right? In portfolios. I think that makes a major effect on Apple, right? Just kind of question, because I did get the question in the chat. I didn't address it earlier. I am all out of Apple, got out at the break even. So yesterday, that was 186. I did take half profits into 189, but that's all I did. And I was looking for the move up, and that's how you do it. You get out, especially on a trade like this, because when it turns back on you, especially when you're buying, like chasing a little bit, because I was chasing up to the 186. I could already say that. You got to get out. And now that it's turned, and overall, did you see NVIDIA's move also? I mean, that wasn't, I don't think, anything for the faint of heart either, Dennis. What do you think about just overall also NVIDIA?
Again, I'd rather own
around?
NVIDIA over Apple. I said it yesterday. I don't want to own either of these. I'm not paying 47 times. It's just not my style.
Yeah.
From an investing standpoint, I've always been more of a value type of investor. I don't mind trading stuff. I trade Apple, trade NVIDIA. That's all cool. I just think, the valuation is, and now if you look at the technicals, very concerning that NVIDIA didn't make a new high. You failed up at 500. You didn't want to fail up at 500. So now you have a retest of 450. We're in a range right now. Does the 450 hold? We got a double bottom. You can clearly see the support on NVIDIA at 450. So that's the level, down $10. I think you buy at 460. I think you're $10 early. I think you take a shot at 450. Maybe it bounces off of it again, but that's your clear line. This is very technically trading 450 to 500. So you're in a channel here. You're in a new channel for NVIDIA. Does the 450 hold? Comes down the first time. I think it holds again, maybe bounces once. So I might take a shot as a trade from 450. But NVIDIA, again, is not going in the long-term portfolio. Not right now.
Let's get to earnings. Let's go to play here. Dave & Buster's Q2 earnings, adjusted EPS at 94 cents, beats the 93-cent estimate. Sales of 542.1, missed the 559.0 million estimate. Dave & Buster's increasing the remaining share repurchase program and authorization to 200 million. Raymond James coming in and downgrading Dave & Buster's to outperform and lowering the price target to 55.
Man, play. I don't know. This is again just a victim of everybody's like these restaurants aren't doing that great here now. Victim of a little bit of the slowdown. Victim of people going into these restaurants. And I know they say they've beaten inflation, but it seems like I go out to eat and I'm like, when in the hell does it cost me $100 to go out for dinner with my wife? Like, at a semi, like not even a fancy restaurant. Everything just seems like nuts. And I think it's catching up. And I think the consumer is getting a little more strapped. And that means they're going to do a little bit less. So, I mean, and, we've been arguing that on this show that they're still finding money to travel and do things while the airlines are starting to come down. So maybe that's not the case here now. Maybe the consumer actually is getting strapped here.
Yeah,
Maybe interest rates are starting to work. Some people are saying, there is a lag. And I think that could be correct. So I don't know. This is filling a gap. Take it technically here. Go back to June, 31.81 the high, up to 37.47. So you're in a gap area here. I don't think you're touching it until at least 33.75. Sorry, was the top of that candle. I don't think you're touching it until at least fills that gap down to 33.75. So no thanks for play.
Yeah, I think this is the story that we're going to hear a lot of going into October, November, and December, right? Will it be the destruction of the consumer? And I think that that's things we need to be looking out. Now, one area that you just mentioned, airlines, I do have a position in American. I think you still have American too, right?
Yeah, I do. I wish I
All
did.
right, so we're both in it. We're both in it, Dennis. There's very rare times that Dennis and I are in the same position. I'm looking at it
all
more as a
depends on
swing
time
trade.
frame too. So it's funny.
Yeah, that's what I was going to mention.
My
I'm on
time
swing
frames.
trade here.
Just one sec, Mitch. Sorry,
Yeah.
which is about time frames. I have two time frames really because I'm not really a swing trader type. You're actually. It's funny. You're in a time frame that I don't really trade as much. I day trade an intraday trade, which is 24-hour time frame for me, 24-hour max. Because I've told everyone this. I go to cash typically at 10 or 10:30 every single day. My day trading portfolio has rules, and this is how I've traded it for the last 15 years, 10 years. I go 100% cash every single day, winners or losers, on my day trading portfolio at 10:30 a.m. because then I take a couple hours in the middle of the day. I don't trade typically from 10:30 to like 1, 2 o'clock because it's just chop hour. And, I'm all about like inefficiencies. I like overnight trading. I've kind of went from intraday trading to being an overnight trader, trying to find edges, overnight, trying to find, those 2-day moves. I've talked about all types of different types of my strategies. You listen to the show for more than 6 months, you kind of know how I trade. But so I have that time frame, and I have my long-term account where sometimes if I'll enter something long-term and then I have second thoughts, and I take it back out. But, longer term is months, typically to years. So I've got American Airlines. I took a half-size starter position in the long-term account, back up at, I think it was $16, and it's been a disaster. So it's down here at 14.30. You, on the contrary, are like on the one time frame that I don't trade, which is why maybe, we work well together here, is you're in that couple days, couple weeks time frames. And I will swing trade from time to time, but I haven't really been doing a hell of a lot of it lately. So, I mean, your American Airlines is a lot different than my American Airlines, even though it's the same stock, because I'm looking at a valuation, reasonable. I don't have much exposure. I'm 60% cash. I'm like, I need to add a couple stocks. I'm like, here's a company that's making money. It's highly cyclical, so that could come down, which is probably why the stock price is coming down because people are starting to run out of cash to go on trips. But I mean, from a technical basis, you can trade anything from a swing trading perspective. So your American Airlines, with my point being, is much different than my American Airlines. Tell me why you're in this for a swing trade.
Well, my thing is first, it was just levels. It's just technicals first. Like that's just going to be it. A lot of the times, that's why I'm looking at charts just to kind of watch them. And the weekly trend line here, coming from the high here of 21, kind of gives me that throwback look where you get a nice breakout above a trend line, a major trend line, and then you want to see it come back and hold that trend line. So I've been looking for a reversal back through 15. Slowly trying to size into the position. I've taken 2 of my buys. I usually go into 3 entries. So right now I'm averaged at like 14.94. So I'm looking for the move back up through 15. I'd be looking today to see if it holds 14. Really don't want to get it back towards like, let's say 13.50s. That would be like the area where it's like too much pain to get out of this trade. But also I take a look at, what could happen here. Right? Oil's gone up, right? And that's what I think has drawn this pullback, right? If oil can start coming down at any point in time, because we know how it kind of fluctuates. It goes up and then down. That's what I'm going to be looking for to start downtrending on maybe some oil. And then all of a
Yeah.
sudden, American takes back off. So that's what I'm looking for. And if I look at some statistical data, and I can give you guys this right here in the chat, this is the June kind of 23 airlines. This is from the Bureau of Transportation Statistics. And it just shows, I mean, airlines are at least the consumption that they're using shows that, hey, that consumption is really high. And that's why the cost affects the companies. And I can show you guys that right here. Like right here is the cost of airline and fuel. And here's the consumption, really high, right? And so that's going to affect the airlines. But also, as soon as that starts to turn, I've been seeing them make the money. And yes, we have love with concern, but I like the three: American Airlines, UAL, DAL. I traded these before and I rode the wave. I sold it too early. So I'm looking to get back in on pullbacks.
In normalized markets, airlines have always been inversely correlated with the price of oil. And that's what we're coming back into. When the VIX starts coming back into 13s, 14s, when the VIX is up at 30, everything's just moving together. A stock is a stock is a stock. But when the VIX starts coming back down, that's when you start seeing those pure relationships start to work again.
Yeah.
So you're exactly right. Oil prices increase is bad for airlines. Being long oil is like being short airlines. So, I mean, that's just been the trade. That's worked for 23 years of my trading career. I've always, I used to always be oil's up, I'm short in airlines today. I used to day trade it like this. Oil's down, I'm buying airlines today. And in this market that we've seen the last couple of years, we've just have an elevated VIX, and those relationships just haven't been working. But what we've seen lately as volatility has come down, those old relationships, that's why I always say a trading strategy that works today doesn't work tomorrow, but it might start working again next week. So when you figure out, these little edges in these trading strategies, just because it's not working today doesn't mean it's not going to start working again a month or two from now. So I think Mitch has given a very good point, which we haven't talked about on the show for a number of years because it hasn't been working, is that airlines are inversely correlated with fuel prices. And oil goes up, it's just common sense that airlines should go down. Again, when the VIX is at 25 or 30, none of that works because a stock is a stock and everything's just moving together. As the VIX elevates, stocks all start to move together. That's what you need to understand too. When you get to 50, 60 on those crazy VIX, stock is a stock. Like, I tweeted out this image, and maybe you could go show that image. It's just a fun conversation from yesterday, Mitch. It was from Evan at Stock Market News. He tweeted out just a throwback from the March 16th, 2020 day. This was a day. Show this picture here just for fun. So this was the peak of the COVID sell-off there, March 16th, 2020. Bring it up there on my Twitter feed. And this was just incredible. Blow that image up. So this was not monthly returns or yearly returns. This was the returns that a day. This was what happened. So if you just started trading stocks in the last couple of years, this happened in one day, folks. Google down 10.27%. Microsoft down 11.84%. Apple down 12.46%. Berkshire Hathaway down 10.92%. What do all those stocks have in common? Nothing. All these like other ones like Johnson & Johnson down 7%. And look at the other ones like UNH down 10.9%. It has nothing to do with Apple. But the VIX was so elevated that stocks were just all moving together. We were worried that COVID was going to end the world. And that was the very bottom. That was basically the bottom when all these stocks collapsed. JP Morgan down 18% that day. These weren't monthly returns.
Yeah.
That was in one day, folks. That was incredible trading action. Crazy moves. But what you have to understand is when the VIX is elevated to that extreme, and I think it was like the 60 or something that day, everything just moves together. And that was an incredible sell-off, and it's something to think about. So there's lots of different ways to trade. You've got to be, understanding trading for your environment. Today, airlines and oil are now once again inversely correlated.
Let's go to the disaster stock of the day. I'm going to call it ChargePoint. Is anybody charging at this? Let's take a look. ChargePoint Holdings Q2 EPS at a loss of 24 cents misses the loss of 15-cent estimate. Sales of 150.49 million missed the 153.2 1.24 million estimate. They expect Q3 revenues of 150 million to 165 million on the high end. The estimate, though, that was given was 181.63 million. So even on the high end, they're off like about 16 million on the high end guidance for Q3. So not looking good here for ChargePoint. Full year revenue outlooks 605 to 630 million. Estimate was at 674.94. So this is another big miss. Even on the top end would be about 44 million off, close to 45 million. That's pretty big here for ChargePoint. And it just goes to show me we're all looking for this EV wave. I think this doesn't happen till like 25. We've been ahead of the game, looking for this to take off, looking to see the infrastructure move in the markets. And I look around, I don't see any building, a massive building of charging stations. I think this is definitely something that's going to get pushed back.
Okay. None of that matters. Plasma has it. Ding, 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 ding. These stocks were doomed as soon as Tesla started working with Ford and GM and talking about the charging stations and putting in charging stations for them. The day that that news came out, that Tesla was going to start working with Ford and GM and the big three and start working, with other companies and obviously incorporating their chargers into their charging stations. It was doomsday for Blink, for ChargePoint, for all those other companies here. Tesla will eat their lunch and spit them out. I think ChargePoint, Blink, and all of them eventually go bankrupt. This is just my opinion. I don't know anything for certainty. I think eventually they all go bankrupt because I think Tesla, I don't think you can compete with them here.
Well, you guys, I don't even know what to say.
I'm very
after
opinionated today. I may be wrong. I don't have a crystal ball, but I can kind of put two and two together. It's going to be hard to compete with Elon Musk in charging. So Plasma, completely agree.
AI, how do you feel about AI? Let's go to C3 AI. Q1 EPS loss of 9 cents beats the loss of 17-cent estimate. Sales of 72.4 million beat the 71.59 million estimate. C3 sees Q2 total revenue to 72 to 76.5 versus a 73.81 million estimate, and sees their full year revenue at 295 million to 320 versus a 308.2 million estimate. They did try everything, I think, here on the release. They released a new product here, C3 releasing new C3 generative AI suite, first domain specific generative AI solutions for industry, businesses, process, and enterprise systems. Yet this chart, and I've been waving it goodbye because I feel like it's going to come all the way down.
This was the hype stock. This has got the ticker symbol. This is like the peak of the AI bubble. This bubble for AI, the stock has burst. NVIDIA will be back. This stock, I don't think will be back. I think eventually this stock is a hell of a lot lower. I think when we look at it 2 years from now, I think it's back to $10 from where it came from. So unless they can figure it out, and maybe they can, maybe it'll change your mind. As traders, you are always entitled to change your mind, but this is not I'm putting in the long-term account. I'll say that.
Yeah, AI is just one of those things. What caught me is I saw the investor presentation. If you guys don't know about a stock, one of the best ways to take a look at it is look into those days, right? Because they're going to talk about everything they have possible moving forward. And what I saw in that investor presentation, and I've mentioned it before on AI, is I didn't see anything competitive advantage. I always look for something that other companies don't have. This company just has what everyone else is looking at, I think, in generative AI. So I think that eventually this just gets hit right back down. American Eagle Outfitters, what's going on there, guys? This did a pop and a drop. I don't understand what happened on the release. You tell me, Dennis, if you watched it. American Eagle's Q2 EPS 25 cents beat the 16-cent estimate. Sales of 1.2 billion beat the 1.2 billion estimate. Eagle Outfitters raised their full year 24 operating income guidance from 250 million to 270 million. Now raised it up to 325 million to 350 million. Q3 management outlook reflects revenue up low single digits with operating income in the range of 115 to 125 million. So it's still being able to get the lift.
Quarter was fine. Wasn't fantastic. Was fine. Stock is fine. That's about it here. There's not a lot of movement. It went down initially, then it popped last night. I don't know why it was popping last night, but it did. It got up to like 1760 or 1770. Now just kind of hanging out. So the algos don't know what to do with it, so they ain't touching it. They're too busy trading Apple.
All right, let's see what comes in here for jobs number. Initial jobless claims at 216,000 versus 234,000 estimates. So initial jobless claims coming down, even though we just saw unemployment spike up, right? I see these jobless claims and these numbers. I honestly don't understand them. I've gotten to the point where why even understand these? They're all over the place. One tells us that unemployment's going up. The other one tells us that we're not getting the jobless claims. I don't know, man. At least for the jobless claims, it's almost to me like there's no edge on there. But what do you think here, Dennis?
Market is just in this sell-off mode here right now. So it's funny. We can be glass half full or glass half empty. Last week, this market was glass half full. Today, this market is glass half empty. So it all kind of depends when these numbers report on what kind of market environment you're in. They were rah buying last week of August. Now they're rah selling first week of September. So, we sit here, and again, why I say these numbers can be interpreted either way, because if you see the slowdown, then they're like, oh, well, that's good because the Fed will start lowering rates. And, if they see a rise, well, that's good because now we can get the soft landing. That's the bull camp. But then you can look at it the other way and say, oh, no, we're not going to get a soft landing. And, oh, no, the Fed's not going to start lowering rates.
I laugh because...
so you just keep going back and forth here. And the Fed is pretty much done. Let's call it out here. The Fed is not lowering rates anytime soon unless we go into a serious recession. But the Fed's hiking cycle is pretty much over. We might have another quarter. It's pretty much at the peak rates here right now. We're not going to 8, 9, 10%. The economy would just cease to exist at a certain point in time. Like, it can't handle it. Everyone has too much debt. People will say, oh, we had it back in the 90s. Look at the rates in the 80s. Yeah, well, people didn't have the kind of debt that they do today. So there's just a lot more debt today than there was 30 or 40 years ago. People used to have to put 25% down to buy a house. Now they basically don't have to put anything. So, the world is just a lot different place. It's incredible that the economy has been resilient as it has with the rate increases that we've just went under. So it's impressive. The Fed is pretty much at the end of the cycle. Does that mean we come in to buy stocks? No, because we just don't know the repercussions here yet. I don't think the Fed starts lowering rates until they start seeing the economy fall off a cliff. So if the economy falls off a cliff, stocks are going to go down. So could still be some trouble ahead. I'm sitting in the cautious camp, meaning I'm not fully bearish, not fully bullish. I'm just kind of sitting here and watching it, go down. And I'm half cash on my long-term portfolio, just in case it starts to get ugly.
TLT not looking the best. It's starting to fade off after this morning was looking like it was starting to climb back. Now back towards 93.64. And I definitely see these levels underneath around 93.50s as support. If that goes, watch out, team. TLT could be coming down a little bit further. GameStop. GameStop's Q2 EPS coming in at a loss of 3 cents, beats the loss of 14-cent estimate. Sales of 1.16 billion beat the 1.14 billion estimate. GameStop cash and cash equivalents and marketable securities were at 1.195 billion at the close of the quarter. GameStop will not be holding the conference call, though, to discuss the second quarter financial results, as the company chose not to have a conference call after the first quarter financial results. Now, just on a separate topic, and maybe we can just talk a little bit about this, they will be releasing a movie that might bring GameStop back into the limelight, a movie called Dumb Money. It's going to be released on September 22nd. The movie is from Sony, and it's all on, of course, GameStop stock versus the hedge funds, short sellers. It's going to hit theaters on September 22nd.
GameStop, the stock you can't talk about, because if you say something bad about it, everybody hates you. It's the same as AMC. I say something bad about it, everybody hates me. So I don't say anything bad about these stocks for those reasons, but I'm not buying them anytime soon. Let's go to Dave Lauer, though, who, he's getting into some market structure talk here because AMC is a good segue in there. He has a lot of ape friends there, Dave Lauer, and he's pretty good at market structure here. I think we should go bring him on.
Hey guys.
Hey, how we doing, Dave?
Good. How are you?
You ready to talk a little bit? First, let's talk about this lovely movie coming out, Dumb Money. What do you think about the title here? Sony going on a limb calling them Dumb Money. What do you think about that, Dave?
Yeah, I don't know what to think about it. I have not seen anything about the movie. I don't know. It seems like there's so many movies about this stuff.
Yeah.
And I'm not optimistic they're going to do this one justice. Like I think there are some pretty good stories to tell about the last couple of years and how retail came into markets, found stuff, that it didn't like, found some of the shadiness and manipulative activities and said, this isn't cool. And I think that's a good story, but I don't trust Hollywood to not sort of overly dramatize it and, get a lot of facts wrong.
Well, let's get to what the facts really are here, Dave. And you've been working obviously in market structure for it's got to be going to 15 years here now. So you've and I've learned a lot from you over the years. I've known you from back in like 2009, 2010, I think is when we first started talking together here. And it's been like a funny market because back in 2009, 2010, nobody cared about market structure.
Yeah.
We would talk this stuff on the show and you can just feel everybody's eyes glaze over when you start talking about the market's plumbing. I mean, it's so important, even as a trader, I think, to understand this stuff. But, it's different because this retail environment kind of started to like this stuff. And the stuff that you were talking about, and obviously, the AMC and the ape stuff and all that, but they kind of, like hearing about this stuff now. So tell us, one, talk about this evolution of, maybe the retail investor where they didn't care about the market's plumbing. And they all of a sudden seem to care about the market's plumbing. And then maybe we can talk about some of the holes that need to get fixed.
Yeah, I mean, it's been funny, right? It's especially you talking about GameStop just now, and how you don't want to say anything. There are two sides to the coin, right? Because there are a lot of people out there that found market structure through GameStop and through some of these other stocks, and what they found they didn't like. And stuff that we had been talking about for many years, it never made it past, it never bubbled up, right? And Flash Boys was a really interesting time, in 2014 when Flash Boys came out, and there was like this brief amount of popular attention on market structure, and then it went away again. And it seems to me that was because it was very focused on the institutional side and the institutional issues. And now retail, who has come into the market, looking for, right, buying into the story that this is where you get a better life. This is how you save for, and build wealth, and seeing a lot of wealthy people do that, wanting the same thing, wanting to invest in the companies they love, and finding them, in many cases, I think, manipulated in certain ways. And, they didn't like that. So they wanted to learn why. And then they saw, when you start explaining markets and market structure and these crazy conflicts of interest and all of the insidious stuff everywhere, it's not that hard for people to understand, right? Conflicts of interest are not hard for people to understand, even if market structure is relatively complex. And how Wall Street might be ripping them off is not that hard to understand, even if the exact mechanisms are somewhat complex.
Let's dive into some of these conflicts of interest here. Just maybe somebody tuning in for the show, seeing you for the first time, and you've been a market structure expert here, like I said, for the better part of 15 years. Talk about the conflicts of interest that, one, first concern you, and then two, how do we go and fix this?
Yeah, I think the best way I've come up, I think, to sort of summarize it is free trading is not free, right? You think it's free, you press a button and you don't pay anything, you think. Whereas in the past, maybe you paid $5 or $6, $15, I don't know, depending how far back you go, $50, right? But, back there used to be commissions and now there aren't commissions. But that doesn't mean it's free. And for anyone to think that something on Wall Street is free, you should have your head checked, right? Nothing on Wall Street is free. No one's giving you anything. And so you have to start to ask, well, wait a second, if I'm not paying something explicitly, and when you pay something explicitly, there's actually a benefit to it, because brokers can compete over it, right? They can compete over commissions, for example. Now, and I'm not saying commissions should be brought back, but that by taking a cost that's explicit and making it implicit, which is poor execution quality, that's where you're paying. right? And so the conflict of interest at the heart of retail is that all of these orders from retail brokers go to a couple of firms. They don't go to the stock exchange, and they don't get competed over by everyone in the market, market makers, proprietary traders, institutional asset managers and such. They just go to like 3 firms. And that's a big problem, because that means that those firms don't necessarily have to compete in the same way that they would have to compete if they were competing on a level playing field with hundreds of other firms. And so that results in inferior prices for retail. But what it really results in is it results in spreads in the market are much wider than they otherwise would be. So every time you see that spread in the market, and maybe it's 2 cents, 3 cents, on average, it's 30% wider than it would be otherwise if all of those orders were going to the stock exchange. And to me, that's a big problem, because markets are supposed to focus on price discovery, right? Getting those tight spreads, reducing the cost to trade, and capital formation, which is, even another part of it, where when firms don't trust the markets, they're less likely to go public. And so, I think that there are a lot of efforts right now, both with what we're doing in terms of our advocacy efforts, but also with what the SEC is doing to try and fix some of these problems in the market.
Let's just play devil's advocate here for a second, because I am on your side, clearly been on your side for a long time here. But the argument from these 3 firms and from, exchanges is that, and obviously a lot of people on Wall Street, is that spreads are tight. Spreads, if we go from the data and we look at it, are tighter than they were 15 to 20 years ago. So we're getting free trading in, we have tight spreads. What's the real problem here?
Yeah, so I think that when you really look into it, first of all, just because spreads are tight, that doesn't really mean anything, right? That they could be much tighter. 30% is a big number. Think about the trillions of dollars of volume that's being done in the market. That's a really big number when you think that the transaction cost that volume is paying could be 30% lower. And so, my point is, we should not strive for markets that are good enough. We should not accept execution quality that is good enough. The standard in markets is best execution. And, from an American perspective, and, internationally, other markets as well, you should strive to have the absolute best markets that you can have. And so, just because it looks better than it looked, back when you had a bunch of people shouting at each other on the floor, and things were priced in 16ths instead of pennies, that's not the right bar. The right bar is technology should be revolutionizing markets, and it hasn't. There's been a lot of incrementalism, because the rent seekers know that they can make things just a little better, just better enough for you to be happy, and not really question how are they buying these massive homes and giving each other massive bonuses and making so much money year after year, when markets are supposed to be so much more competitive and so much more efficient. So, I think that when you really tease apart market quality, you find a lot of problems. You find, for example, in stocks that are highly concentrated off exchange, you not only find less size on the displayed quote. So even if the spread is tighter, it's a lot thinner, it's a lot weaker, it's a lot more fragile. So as soon as it gets hit, it moves. And you also find higher extreme price movements. In fact, there's one study that showed that the more concentrated the off-exchange retail space is in a stock, the higher the extreme price movements are by 50 basis points. Right, so these are not small numbers. These are big numbers that really add up. And so, the very activity of diverting all of this flow off exchange is weakening markets, increasing volatility, and increasing costs to everybody, just to enrich a small set of firms. And of course, the practice was popularized by Bernie Madoff. And so, again, maybe we should be questioning anything that he did and rolling anything that he did back.
Well, let's talk payment for order flow, because that's what you're alluding to here with Bernie Madoff. And payment for order flow has existed in this market for a long time. Different types, obviously, exchanges pay to have limit orders, because, you got the maker taker where they're obviously there. And then you have, your internalizers that are paying for that retail flow, and they're paying. And that's how, Robinhood exists, because certain firms pay for their orders. They will actually pay to trade against your orders. And what it is, it's really first dibs. I want first dibs to trade against Joe Investor here because I don't think he knows what he's doing. So that
That's
dumb
right.
money title right back to that is like, wow, I want first dibs to pay against that dumb money. Don't let that order go into the public markets to have free and fair competition. Just give it to me, and I'll be sure I'll give them a good price.
Yeah.
But are we really sure it's a good price?
Exactly.
How do we fix this though? Like I mean, and again, this is something that me and you have talked about for 12 or 13 years. How to fix the issue? Is it just ban payment for order flow? Because maybe these orders still go to these firms, or is there something more? Do we have to do more than just look at just payment for order flow?
Yeah, so I think there are a couple of things you need to do. It's really hard when you get into market structure to sort of solve one problem. There are a lot of things that have added up over time. We haven't really had an overhaul of our market structure since 2005 when Reg NMS was passed. So we're talking 18 years now that we haven't really revisited sort of the fundamentals of markets, and a lot has changed in that time. So what the SEC has proposed is a set of 4 equity market structure proposals. The first one is to give more transparency and visibility into execution quality. So an expanded and updated Rule 605. That's a great thing. No one's really arguing with that. The second thing they said is let's update Reg NMS and let's revisit tick sizes. And so for tick constrained names that are always trading at a penny spread, maybe they should be able to trade at a half penny spread. Now the SEC has said, even tighter. A lot of people don't think you should go much tighter than a half penny. But there are highly liquid names that could be trading tighter. On the other end, this is not in the SEC proposal, but there are names that trade at wide spreads, and maybe we should consider widening the increments for those in order to encourage more displayed liquidity. The tick size pilot, which the SEC ran many years ago, was sort of derided as being a failure. But the problem with the tick size pilot was they widened spreads for every stock. They didn't look at whether those stocks were tick constrained or not tick constrained. And that's a really important consideration. And when you tease it apart, you actually find that there were some really good results in the tick size pilot when you split it up like that. So I think that's sort of step one, is tick size and more transparency. The next is what you're talking about, which are rebates, access fees, which are the fees that exchanges charge. There's a regulatory price control in markets that says you can only charge up to 30 mils per share for orders that take liquidity. That's called the access fee cap. And that's 30 cents per 100 shares. And so, what I have said and what many people believe is, why don't we get rid of rebates and payment for order flow? Say that those things are not conducive to best execution. They don't fit within a best execution standard. Let's get rid of them. And then you get rid of the access fee cap, and you let fees get competed down to a very small level on exchange. And the SEC has proposed to reduce the access fee cap from 30 mils to 10 mils, but a lot of us are pushing them to do more than that. And then there are 2 more controversial rules the SEC has recently proposed: the order competition rule and regulation best execution. In the regulation best execution, they're saying the SEC should have purview over best execution rather than FINRA. And to get to your question, Dennis, about what do we do about payment for order flow and rebates, they've sort of defined the standard in the new best execution rule. I call it like super best X, which is they define a conflicted transaction, which is a transaction of brokers routing where they're receiving a payment of some sort rather than when they route strictly for execution quality. And the SEC has proposed a sort of higher standard for conflicted transactions, which I guess is one way to approach it, but I don't really see the benefit. And when we wrote a comment letter in, we said, why do all this? Let's just get rid of conflicted transactions, right? Why have them at all? Why try and bend over backwards? Just get rid of payment for order flow and exchange rebates. I think that's the best answer, but you're right. That might not solve the problem because of how warped everything is in markets and market structure. So I think the last piece of it is a trade at rule. And a trade at rules, which exists in other markets like Canada, says that you cannot execute off exchange unless you get material price improvement, which is at least a full tick or a half tick if the spread is a tick wide. And the SEC sort of proposed something like that called the order competition rule. The only thing they put into the order competition rule that's a little different is they said, you know, you can send to these on-exchange auction facilities. And those are a little weird. It's very prescriptive the way the SEC defined them. It's very specific. And so again, the point we're making to the SEC that we made in our comment letters that we've been making very, you know, publicly, very loudly as we can, is let's just do away with that. Let's just do a trade at rule. It's very simple. It's very easy. It's been tried in the US. We tried it in the tick size pilot. The results were great. It's supported by a lot of firms in the US, exchanges, brokers, asset managers. Almost everyone supports a trade at rule. And so it wouldn't have the problems that come along with this new order competition rule proposal. So, you know, I think there's light right now at the end of the tunnel over the next, let's call it 6 to 9 months, in terms of the SEC really coming in and changing markets in a fundamental way, and in many of the ways that we've been talking about now for an awfully long time.
And just to sum up, like, so the SEC has proposed some new stuff here. They've had the comment period, which is now closed.
Yeah.
When do you actually see some of this stuff implemented? Is it going to be like, is it the 6 to 9 months from now? Do we see it in the new year? Are we going to see any material changes here? Because the comments were mixed on certain stuff, like the tick sizes. Some were in favor, some were not. I mean, are we going to see, you think, some material changes here that, you know, the way orders are executed is going to be fundamentally different in 2024 than it is in 2023?
I think we're going to see 605 this year. I hope we're going to see these Reg NMS changes, the tick size and access fee cap changes this year. That's probably more uncertain, but if not this year, probably early next year. The next two, Best X and the order competition rule, or potentially a trade at rule, I think are tougher, but I believe you're probably going to see them before the election, because you know, this is very much, these initiatives are very much being driven by Chair Gensler at the SEC. I think he very much sees these as his sort of legacy on the stock market, and I think he's going to push them pretty hard, because, you know, there's a lot of uncertainty coming into this election, and, you know, I think he wants to get it done before that. And it's funny with Gensler, because, you know, there's a lot of hate out there for him. There's a lot of support in other places for him. And you see two completely different characterizations of him, depending on who you talk to. Either he's done too much and is going crazy with regulation, or he's hardly done anything and needs to act, you know, depending on who you're talking to. So it's kind of funny to see the different perspectives on the SEC right now.
Well, thanks so much, Dave. Let us know, where can we find you? Where can we find out more about these changes and the advocacy that you're trying to do? Let us know where we can find you, because a lot of people are probably interested in knowing more. Yeah.
So, you know, the URL urvin.finance right there, that's, you know, our company, and we lead the advocacy efforts through there. You can also go to wetheinvestors.org. That's our grassroots advocacy campaign. And you can join up there, put your email address in. We'll keep you updated on what's going on. We'll tell you when there are opportunities to act, and we'll help teach you about these issues. You know, our goal is not to speak for anyone. Our goal is to educate people and empower them so that they can be involved in these debates. They can file their own comment letters. They can understand the issues. And that's really what we're focused on.
Definitely check it out, guys. I'll give you guys some of that information there. I'll throw it up in the chat. It's always good to have you, Dave. And it's always good conversation to hear Dennis and Dave together. Some masters going at it. Appreciate you guys.
Yeah, thanks for having me.
Thanks, Dave.
All right. That was a great conversation for sure. I know I get to a certain point, even in that conversation, that even I'm like, let's just let the masters speak. You guys have been at it for some time. And I appreciate it. Just being as a retail trader, I think all you guys appreciate this conversation, because really, this doesn't get talked about often, right? This gets a lot of the times put underneath the rug. So I appreciate you guys bringing up the conversation, and definitely look for Dave to keep pushing for those investors out there. Let's get back to the markets. How are we looking? I saw still leaking there. How are we looking?
We are leaking, not even a little bit. We are leaking hard here, Money Mitch. Yeah, and man, it's ugly. Bottom line is, it's an ugly day for the markets, being led by a tech wreck. And we can officially call this a tech wreck here, because you got stocks down significantly. Apple's down $7 here now, down 3.7%. Tesla's down 3.26%. NVIDIA, we talked about the 450 level. It looks like it's going to get challenged today. It's 457 down 2.82%, but it's tech across the board. You do have pockets of strength, utilities and staples, both green here today. The reason for that is safety trade. You know, people are like, oh my gosh, my tech stock's going down. Kramer told me Microsoft's never going down again, or Apple's never going to go down again. That's down $7. I need you to sell that and move me over into consumer staples here. Give me some Coca-Cola because I need safety.
Let's see how long that works, right? Because even those trades weren't doing the best, right? I mean, we'll see if maybe we turn around because Coke was down like, 4 or 5 days in a row. Maybe we get a little bounce back there.
A little bounce back, but you know what's safer than Coke? Cash. Cash is safer than Coke. But again, now, okay, so let's give a perspective here. We just sold off pretty significantly here on Apple. I mean, now you're coming in bearish. Now you're coming in. We started this show yesterday morning saying, I don't like Apple at 188. Well, it starts to look a little bit better at 176. I'm not saying putting in the long-term portfolio, but as a trade, if you're coming in here and selling with just $12 in 24 hours, that's a 7% move down in 24 hours. It's probably going to bounce in here somewhere. So put your day trading cap here on here. Just as much as we were overbought 3 days ago, we just went oversold on a lot of stocks here. So just be cautious, I think. Just getting your full bearishness in and say, I'm going to short stocks today. You should have been shorting stocks yesterday morning. Now is the time to probably ring the register, as much as like Roku. Remember Roku yesterday popping up? Oh yeah, it's got good news. And we said yesterday this is your ring the register opportunity. That couldn't have been proven more true by the market yesterday. $95 yesterday. It's $84 here today. Now, I'm not coming in and saying load up your long-term portfolio. It's all about, who, your horizon and obviously, what you think, like you want your cash in your stock. I'm sitting half cash, half stock in the long-term portfolio, kind of maybe bringing in. So if you are short this market right now, probably looking to cover some stuff here, maybe into a little bit of this weakness, because I don't think we're going straight down. I don't think we're going straight up. I think we're going to be choppy. That's what I said yesterday morning. This is the chop down. This is the wave down. So I think you start thinking about some support levels. NVIDIA 450 is huge support. Do I take a shot there? I might. Gets there. It's the first time off of it from 4 or 5 days ago. So does it breach it? It could, but you can put any trade on as long as you know where your out is. I'd say below that 448.88 low, you got to be cautious on NVIDIA, but it's one that I'm looking at for support. So with my day trading cap here on, I'd be looking to bring in shorts into today's action.
Yeah, I agree with you. I think that now if you're going after it, you're going to feel like a little bit like you're chasing a little bit. And that's how a lot of times when we get these gap downs, it seems like we could get a little bit of run at the gates. I'll be looking for the opposite of just straight chasing, maybe looking for green to red moves. We'll see if that happens. A lot of times we get a little bit of a bounce. An area definitely to keep watch. And I still am pointing towards it because it just doesn't stop going down. Look at the banks. I don't think anybody's really focusing on this. Maybe I'm just the first and the only one that's looking at it, but I don't know why. This seems to me like a little bit bigger than just a pullback, right? Look at the XLF. Look at the KRE continuing to go lower. We talked about this on Tuesday and Monday. Look how it's been going. It's down about 5% and going back into this space here. This long-term trend line. Head and
we
shoulders.
Talked about this head and shoulders yesterday. Yesterday's action didn't do anything to ease our concerns here.
Yeah.
I'm with you, man. I don't think it's over. I don't think
it's over either.
I think you're going to get more weakness in some of these regionals. I would not touch any regional banks. Just the risk reward just doesn't set up well. We watched some of them go to 0, 4 of them. I just think it's not over yet. So the banks, I'm going to keep saying, have been a terrible long-term investment here since the financial crisis. JP Morgan accepted. It's obviously been very good, but we know Citigroup has gone nowhere in 15 years. Some of these other banks really underperformed the market. We've had an incredible 15-year run in this market, and the banks have hardly participated. So do they start? Is this the catch-up? Is this the difference? Sometimes on a day like this, they're looking for something alternative to tech that maybe the banks can get a slight bounce here, but I'm just not a fan of the banks either. And I'm not trying to just go full bearish and say, sell everything, the end of the world is coming here. It's not that. It's just that we're
tech run.
overextended on a lot of stuff. And the banks, but I just think risk reward for the banks just never sets up well.
Yeah, it doesn't set up well at all. And I mean, it's clear that we could have some more trouble in tech, right? I think just continuing to watch the leader is going to be what I'll be watching. Microsoft also started to come back, and I was wondering, okay, will it show me strength? Will it start making its way back to 350, 360s? And then yesterday, it just turns right back down. So we could be in some sideways action there for Microsoft. That's one of the stocks that I wanted to see if maybe it'd lead the rally back, but short-lived little push back up. So we'll see what happens with these stocks. Let's wrap it up here, Dennis. It's 9 a.m. It's going to be a tough day for sure. I got out of my oil trade just because I don't know what's going to happen with this Chevron. So took all profits off yesterday at 166. We'll see if oil can continue to run. This is definitely something that I'm watching because, of course, it's going to affect inflation also. But XLE is already at the top, right? Maybe we already had that run. That's what Dennis was talking about yesterday. And I can't blame him on that outlook as we're getting near towards the top here for the XLE. All right, let's wrap it up, guys.
I'm just cautious. So, and again, oil's had a big run here.
Mm-hmm.
So, I mean, I feel like we're chasing if we're buying oil stocks here now. They were good buys 2 months ago. This is still a market, a trading environment where you ring the register, your stocks are moving up 10, 12%. It's time to ring the register. You're not going to get these 50, 100% movers, I don't think, in the second half. So that's where
another thing to look out for is maybe growth stocks reversal, because as we get this market to come down, those stocks are the ones that I'm going to be a little bit concerned about coming down a little bit more wicked than others. Are you concerned about growth stocks here, Dennis, as we keep coming down? Like, let's say like ARKK names, like these big, like high flyers, Carvana, Upstart.
I'm always concerned about those names. I just think a lot of those names were overdone. I mean, we had obviously Carvana's, the part of a short squeeze. That continues to hold up well. Does it squeeze them more? It might. These are all pockets of different stories in the market as well.
Yeah.
I just think I'm just trying to keep taking this overall view.
Look at this,
we had a really good first half, and I think we're chopping around in the second half. So I don't think we're tanking. I don't think we're going up another 25%. I think we're chopping around. So this is the chop down. So as much as I was probably, selling stocks, and looking to sell stocks yesterday morning, we just sold off significantly here. So I'm actually looking to buy stuff here today as trades. I talked about NVIDIA, 450. I think it's a huge level. Should we go look at Tesla because it's starting to come off? Tesla doesn't really have much of a level in here, though. 244, 242. Yeah, maybe. But, but would I touch GM or Ford? No, because they got their own individual problems with the strike looming, price, and there's certain pockets where I'd probably stay away from, too.
What looks like a short to me is Stellantis, but that's just because I've been seeing this kind of head and shoulders pattern here. You guys can see it on the daily. If it goes into a strike,
I agree.
Could it be back down to 14, 16?
Yeah, I agree. I'm with you. I don't like that chart either.
It has a lot of resistance at 20. And so that's one of the charts that I'm just looking at. Of course, if they get a good news from the strike issues and the UAW, well, maybe that could be a positive, but this looks to me like a head and shoulders there on the dailies. Just something I'm looking at. I never trade Stellantis, but hey, you guys see it's a lot of gaps on that chart, so be careful also. All right, that's going to do it for us. Like always, you guys can check us out on Twitter. You guys got Triple D Trader, Money Mitch BZ. We're going to wrap it up. Dennis, go do what you do best. And the chat, we did not ban Joel. You see the chat trying to get us to talk about Joel.
He's banned. We got rid of him. He'll be back soon.
We banned him.
When's he coming back?
Get out of here.
When's he coming back?
I don't know if I'm allowed to say. I don't know if I'm at liberty to say.
Anybody knowing his business. Joel's a very private guy.
I might get cut myself if I say it.
Yeah, okay. We better not say anything.
Well,
what to say Joel's a private guy doesn't like people to know his business.
Just put it this way. Joel will be back. And that's for
He will
certain.
be back. We didn't ban Joel from the show. It was a temporary ban. He's coming back.
Yeah. We gave him strike 2. He still has another strike to go.
He's on strike right now. Joel's on strike, but he's coming back.
Yeah, the labor companies are calling. They're trying to get more money.
He's going to get mad
I'll let you out of here, Dennis. Have a good one, man. I'm sure we'll hear about this on Monday.
I'm going to crap for this too.
We have a good time here on Pre-Market Prep. Like always, smash the like, guys. We've enjoyed this. It's always been a good time with you guys, and let's get ready for the market. Like always, be careful out there. Stay nimble. The markets don't go one way, right? We saw that quick turnaround yesterday. Now to bring you guys over to live trading, that's coming up next. Don't go anywhere, team. Like always, Benzinga has it all for you right here. You don't even got to go anywhere. This will redirect you right to the action, so stick around.